this panel on the relationship between classical banks and Fintech startups in lending. My name is Thérèse Torres. I am a senior editor for Crowdfund Insider, which is the publication of reference in everything crowdfunding and crowdlending. I will ask the panel to introduce themselves in a minute, but before I would like to posit the question that you see here on the slide in a slightly different way, you know. Banks and online lenders are their new best friends. We have seen in 2016 a lot of collaboration between established incumbent banks and fintech startups in the lending marketplace market. And many observers say that we will see even more in 2017. However, I would like to provoke the discussion by asking the panel a more incisive question, which is the question of where is this going? You know, at the end of the day, even in collaboration, some win and some lose. Some disappear, and some establish themselves as the leaders. We are seeing in the UK that some fintech marketplaces are becoming banks. Zopa took a banking license in 2016. We are seeing banks like Goldman Sachs or Commerzbank establishing themselves as marketplace lenders. So, you know, in the world of co-opetition or collaboration, it's interesting to ask ourselves, what is the future of this industry? Will banks absorb all marketplaces? Is it the future of marketplace lending as it is for the first generation of online banks? And we have not a single independent online banks nowadays. Or is the future of lending the same as the future of e-commerce or the future of media, you know, which is now pretty much written? Amazon has a 40% market share of e-commerce in the US, 40%. You know, will an online lender, a lending club, a funding circle, emerge as a major player? Will banks be relegated to being commodity plants, you know, commodity factories, building low interest rate products for the masses? Will banks be able to maintain their customer relationship? So this is the question that I'm positing, and I will ask every panelist to share his point of view about this issue, about the end game. Who do they think will win and where? And to present, of course, how their company is bearing on this issue. And we will start with Mariano, who is the banker.
Hi, my name is Mariano Belinky. I'm managing partner of Santander InnoVentures, which is Santander's global corporate venture capital arm. Our focus of investment is to find companies with which Santander can collaborate with and work together with to bring value to our customers around the world. And as I'll talk a bit later, I think the reason I was invited to this panel is we made an investment in US lending platform Cabbage a while back in 2015, and we've been working with them trying to explore how this collaboration could happen, and we are currently working in the UK together. They are our main platform for working capital loans for small businesses, clients and non-clients. So if you live in the UK and are a small business and you want a working capital loan from Santander, you will go through the Cabbage process as our only channel for that product and that segment. Do you want to answer the question first?
I would like you to share honestly your point of view, which you told me is that banks will dominate this market.
So I don't believe in the sort of dichotomy of winners and losers. I don't think. I think that's a very 2015 way of thinking about fintech. I think fintechs will change the fabric of financial services, and they will become an intrinsic part of it. But I think we are moving towards a world where we have both. I don't think one side overtakes the other. I think there's a natural place for banks as transformers of risk. I think that even with decent traction by most marketplace lenders, there are a number of open questions around the quality of the risk originated through a full cycle, the sustainability of the originate-to-sell model, and whether they are having an issue of adverse selection just by the nature of how they acquire customers. That still needs to be solved over time, and the only way of solving that is just going through a full credit cycle. And I think, given that banks have been gone through that full cycle, they have the natural components to make that collaboration a very effective one. I think we're also going to see some evolution in the regulation. I think the idea that some of these platforms are originating loans of not so great credit quality and placing them with retail investors, with those investors having not necessarily a full understanding of where they're putting their money, will make some regulators get a bit nervous. And I think we're going to see a bit more regulation on the marketplace lending activities. And so the end game, again, for me, it's probably one where we coexist, where we take the best of each other. I think we will see some of these players become big and become established and solve some of the questions that I mentioned before. Others won't and will be absorbed or will just die. But we've seen lending is in the Bible. I mean, lending is probably the oldest financial activity that humanity knows, and so it's just natural that new players with a particular value proposition enter the market. Again, it's not a zero-sum game. It's not a winners and losers game.
So Mariano is representing the point of view of the best friends, best friends forever. Now, I'd like to pass on the word to Cédric, who represents the marketplaces here on this panel. Cédric, you've been very independent from banks from the time.
Yes, we are. So thanks, Therese. So, hi, everyone. So I'm Cédric Teissier, co-founder and CEO of a company called Finexkap. Finexkap is based in France, and we provide invoice financing company. We started lending to companies about 2 years ago, and we've been the largest invoice financing player in continental Europe since. And we've played the independent card for many reasons. We wanted to go fast to market. We wanted to be very agile. We wanted to be in control of what we could do. And also, actually, when we met with banks a few years ago, it was difficult at that time really to find the right partner that could understand that. So it was just natural choice. We've been backed by asset managers, insurance companies, family offices, PE investors. We come from PE with my co-founders. And to answer your question is, I believe that it won't be either banks or it won't be the online lenders that will win, it will be customers. What we've been doing ever since we started working on Finexkap is identifying the loopholes in the way companies, so we provide invoice financing, that's for SMEs, the way companies can get access to factoring activities. And it so happens that it's super constrained, it's very complicated, you need to commit for a certain duration to sell a certain percentage of your turnover, you need to provide a personal guarantee. It's super long for an SME in France. We estimate it's about a 4 to 6 week process to get a financing. That's not what customers want. And what customers want is transparency, simplicity, easiness to access, flexibility, and being in power. So basically, we take these needs and we build something to answer these questions. So when you do that and you're independent, of course, you're smaller than a bank. Of course, banks are 100 times bigger than us. but we actually answer a need. And I believe that, for some reason, at the end of the day, that need will find its way into scalability. Will it find it alone? Maybe not. Maybe we'll need to get, bigger partners to work with. But you can't do that without partnering with a bank. You can do that these days by partnering with the right distribution channel. So for example, with Finexkap, strategy going forward was we needed to find a point of entry for the distribution that would be an access to a multitude of potential customers. And that access can be a software editor, such as an accounting software, an e-invoicing software, a collection software, a B2B marketplace. You mentioned Amazon. Amazon has about, 10% of the global e-commerce activity. They're now launching B2B marketplaces in all the countries in the world. They started in the US. They launched last year in the UK. They're going to launch next year in multiple European jurisdictions. And guess what? Amazon is looking for, obviously, financing the B2B invoices. Is it easy to do that with a bank? I don't believe so. Is it easy to do that with Finexkap? I do believe so. So you may find your way without the traditional, vertical approach of banks. That doesn't mean that Finexkap won't partner with a bank. We're very opportunistic. What we're here to do is actually providing the right service to the right person the right way. And it may well be that it will be with Santander, it will be with another bank, it will be, with someone that share that same vision. So I don't think we can really answer that question. It may be actually both together. It may be one. What we know for sure is internet is just, internet has built a monopoly in the past. We've seen Google, we've seen Facebook, we've seen Amazon, we've seen Alibaba. Maybe we've not seen yet the online lender that will become that monopoly. But maybe that person is working somewhere in a garage, that happened in the past. So we'll wait and see, but that may be actually
maybe
the
that
answer,
person
yes.
is in the room.
Exactly.
So we need, Cédric was saying, we need the Mark Zuckerberg or the Jeff Bezos of finance to really disrupt lending.
Yes, for sure. I mean, and again, maybe, it will be actually these players. Maybe it will be Jeff Bezos actually doing it. Mm-hmm. We see Facebook coming into payment now in Europe, so that may be a big thing. That may not be. There may be that banks will keep dominating. But for sure, there will be something coming from internet, and it may be with a bank as well.
Yeah, thank you very much for this point of view. I'm really subscribing to what we're saying. The question is really open, and I'm insisting on that point because it seems to me sometimes at this event in particular that there is this soft consensus about the fact that yes, banks and fintechs are all best friends, and it's such a nice world, But I think it's important when there is this type of consensus to stay alert, and to stay vigilant, to defend your own business and look at, the potential threats or the potential upsides. So now I would like to ask Markus to give us a bit of a third-party point of view. Markus, can you introduce Crowd Valley and how you deal with banks and fintechs and what you learned from this experience?
Absolutely. So, thank you for that. My name is Markus Lampinen, and I am based in San Francisco in California. So just as context, I came here to Paris on Sunday, and I've been meeting with banks that are 150, 200 years, 250 years old, talking about how they actually adopted those strategies and serve their clients better. So what we do is we're a cloud back office company, which means that we go into these conversations, we work with large institutions, mid-sized finance companies, as well as challengers, so upstarts, developers, like the Silicon Valley 4 people in a garage, and we help them deploy new ways of serving their clients. This might be a mobile app that serves credit better to the customer. It might be a business factoring service that a bank deploys, but either way, it goes into this thought of how is the market changing? How are we positioned, and how do we provide a better service? So you're right, there is this type of soft consensus. What I like about this event in particular, I mean, my background, I started in Fintech 8.5 years ago. So I was in Hong Kong, then I was in New York, London in between, and then now in the San Francisco Bay Area for 3.5 years. So I've been to many of these events. But the discussion here is very substantial. We're talking about very tangible things. So very similarly to what my panelists here mentioned, I actually don't believe that whether or not the bank will survive is the right question. I think that essentially the entire fabric of how we deliver financial services is changing. So we have this one slogan that we often like to think about, that the future banker is a software developer. That's something that we see. Banks are recruiting software developers. They're recruiting people from telcos, from media companies. And these people sit in their new innovation and new business offices, figuring out how to roll out new types of applications and services that clients actually want to use. So our position is very much that essentially fintech companies, the attackers, they will have a positive effect on the market because they will also help the incumbents develop. At the same time, the large institutions that serve tens of millions of clients, they do have a role to play in terms of actually delivering their own services. So like any type of marriage, both parties sort of gravitate toward the middle. And that will happen through disintermediation, consolidation, but also competition. One thing that we're firm believers in, so our cloud back office has an open API. So if, for example, anybody in the audience feels like they're not getting the right type of application from your service provider, go build it yourself. This is what we think about will have a large role to play in 10 years. So you look at the disintermediation of services. There are a lot of vertical services which might not necessarily mean that you have to be a bank to provide them. Investment advice, for example, a lot of wealth management, money management services. You don't need to be a full bank for those. But at the same time, the way that the entire framework is changing makes that there will be a lot of innovators that do come up into the market and push the boundary for the discussion. Obviously, we've been working with regulators, regulatory policy around the world. So our clientele spans from California all the way to Japan and everything in between, 120 plus institutions that we work with. So it is a very, very complicated and multifaceted discussion. But our argument is that essentially all the tools, things like trust that we've been talking about in banking for a long time, the context is changing. So just to leave you with one thought, I was at a trading conference in New York probably 3-4 months ago, and I remember being on a panel where the trader was talking about personal relationships, that how important personal relationships are in closing a deal or executing a trade. Now, I love personal relationships, I love people, but I don't for a second believe that once you can do the deal better, faster, more efficiently, transparently, and just with better results, that the trust is defensible. That will disappear. But it will transform into something different. And that, how that transformation happens, I think that that's a fascinating question that we're seeing.
Wonderful, thank you. So open APIs, cloud-based information systems, and new ways of delivering trust are major change agents in lending for you. Now we have a second, a bit third party on this panel. Mr. Caudoux, who is from Bpifrance. Please introduce your point of view on this lending market.
That makes me the fourth party then. Okay, so I represent Bpifrance. Basically, we are a bank, actually. We are a public bank held by the French state, but we operate as a commercial bank, so we are not civil servants, we are bankers. We dare to say so. And we're here to finance French SMEs and French corporates, basically mostly innovative companies and high-growth companies, either in loans or through equity investments. So we do both. Basically, we lend 6 billion euros of money to French SMEs every year, and we invest directly around 1 billion euro, and indirectly, meaning we are a fund of fund to venture capital firms for another additional billion euro per year. So we see a lot of startups in all domains. It's very passionating to look at fintech because as bankers we are concerned, basically, professionally speaking, and we also see fintechs as some startups, basically like any other startups we need to finance. And third thing, we are here to foster the financing system for French SMEs. And we see crowdfunding as a way to foster the efficiency of the financing market for SMEs. So really interesting for us. To answer the endgame question, one thing for sure, I do not believe in monopoly in finance. I mean, I think it's contradictory, basically. If you look at us, we all have different banks. Even before there were any startups in the fintech industry, we like to have different banks. And bankers like to work with other bankers. So this concept of competition between banks is something very deep. You know, bankers tend to spend their time syndicating or trading with one another. So this will go on. And I don't see how someone would become a monopoly in finance. You have some specific points maybe, you know, in the value chain, but in the lending industry, I really don't believe in that. You know, everyone is feeling better to co-lend with someone. Mm-hmm. Basically, we never, as a public bank, lend alone. We refuse to extend the lend to a company if we don't find another banker to lend with us. So this will go on, because the moment you take the decision to invest or to lend, you don't like to be alone. And this will go on forever. As you mentioned, it's the second oldest job in the world, lending. There's a first before that, as everyone knows, but that's the second one. And it has been working like that for many, many, many centuries. Having said that, clearly, I think most crowdfunders will end up being bought or fail, being bought by banks or by other businesses. And you have to be very humble in predicting that no one will lead the industry. We've seen many examples, so you have to be very humble in that. Yet I do not believe that one crowdfunder could, you know, overcome and become dominant and overcome large banks, which are very diversified. It takes a lot of time, a lot of regulation, a lot of customer trust, a lot of customer knowledge, and again, a lot of technicalities to just be a large bank. But there will be pain for banks, for sure, because it's going to hurt on some very specific points. If you look at this stage at what crowdfunders are doing, I'd say three things. Clearly, as Cédric mentioned, a better customer experience. This is something you can replicate, but it takes time because banks have, you know, legacy systems which are long to move, have very complex organizations, but ultimately either they will buy this new customer experience or they will develop it. Second thing, which is brought by all crowdfunders and which is very interesting to me, is the ability to bring directly the crowd to finance a company. This is new. So this is the new, really new thing which is brought to the market. And that could be very interesting because you don't know how people are going to react, but probably you will find some new risk appetite in the market and some new way to look at how you can finance companies. So this is new and this is very interesting. But it's basically a new way to manage deposits if you look at it from the banker point of view. So this can be replicated or bought. And there is a third thing, which is very common sense, but very important, which is agility. So the agility gives you the ability to size some very specific niche market opportunity. We talked about electronic invoice. I think typically, it's a very good example. There are, in the asset finance area, there are other examples. So there will be people being very successful in this area if you have the three things: customer experience, if you get the good customer knowledge, both for marketing and for risk reason, if you have a very large crowd basis of lenders, and if you can size the opportunities on some niche markets.
I want to take up this issue of, you know, there will be places in the value chain where contenders will emerge. And I would like to talk more about the customer relationship and who owns the customer, who has the best touch point to the customer. Cédric mentioned, in my point of view, rightly so, that the customer of the future wants to make financing decisions at the point of business. It doesn't want to go to the bank just because he or she wants to buy something if he's a consumer. He doesn't want to go to the bank if he wants to finance some inventory, if he is trading on Amazon. And so it seems to me that I've heard a lot here about the difficulty for fintechs to expand their footprint, the huge cost of recruiting online, because there is a huge cost at recruiting a new customer from a blank sheet online. It's very, very expensive, and fintechs burn a lot of cash doing that. But it seems to me that there is that banks are going to face a huge difficulty in maintaining their customer relationships. The PSD2 regulation will enable customers to switch bank account, will force banks to exchange their data and make switching banks or multiple banking relationships much easier than before. We know that the foot traffic at branches is going down very rapidly. So, Mariano, I would like you to ask you, how is Santander addressing this issue of maybe a dwindling of the influence of the bank on its customers?
So I would say I agree with you in terms of being closer to the sort of point of decision. And I think the answer, at least what we do, is be everywhere our customers are, right? We do point of sale finance. We do online finance in real time. Again, through platforms like Cabbage, you get an answer in 10 minutes and you get funds end of day, and that's a Santander loan. So I think just characterizing banks as, or characterizing all banks as single channel, go to the branch, wait 4 weeks, get a loan, is a bit of an oversimplification. I think quite a few banks are omni-channel and are moving in the right direction in terms of being present where the customer expects them to be. And then, sorry, I forgot the second point was.
But you still, as a bank, you still remain vertically integrated, meaning you own the distribution channel, you own the product factory, you own, the entire.
No. We do point of sale finance with MediaMarkt in Germany or with Corte Inglés in Spain. No, we're not.
So
you use the channels where the customer is. We're not. No. By all means, we're not. And I think we're moving more towards owning less bits of the vertical stack and just being present in those. I think the biggest change we're seeing in the industry is that things that were perceived as assets for a bank are rapidly changing. The question of, do you need to own all of your core banking systems, or can you just own the critical ones that give you sort of intellectual property and differentiating features, and then the rest, the commodity bits, you don't really need to own anymore. So I think there is a lot of change in the industry in that sense, in terms of figuring out which parts you need to own and which parts you need to work with. And again, most banks, I would say, have figured out that the vertical integration is not necessarily the best model anymore.
And Arnaud, I want to ask you, as a development bank, at the French Development Bank, you haven't yet partnered with French marketplaces in the same way as, for example, the British business bank has partnered with Funding Circle, just asking them to distribute over 100 million pounds over the past 5 years and in the next 5 years. So is it something that you could do, you could be doing?
Well, yeah, certainly it's something we could be doing, but as we all know, there are some tiny differences between the UK and the rest of Europe, which tend to increase, by the way. So we actually talk a lot with the British Business Bank because it's very interesting. It's a very new bank, whereas we are a very old bank. So basically, they don't have a network of branches across the UK, whereas we have 50 branches across France. So we operate in very different ways, for one thing. And second thing, mostly the banking market for lending to SMEs in the UK is absolutely different from the banking market in France. We have very strong retail banks in France with a very strong will and incentive to lend cheaply to SMEs. So we have a very efficient and very cheap market for credit in France, whereas the UK has suffered, well, the retail banking in the UK has suffered much more from the financial crisis in 2008 and has left much more space for crowdfunding. So there is a need from the crowdfunder in the UK for more cash because there's a lot of demand to answer. Whereas in France, we do not see this demand. So we have different types of partnerships with crowdfunders in France, which adapt to different situations, but basically we don't see this need for more cash. What we see is need for more security or the ability to fund through the markets, through the financial markets, part of what is being extended to their customers.
Cédric, would you agree with that, that there is not as strong a need for cash in the French market as in the UK?
I think at least I agree on the fact that the UK and the French market are vastly different. I mean, we're talking about something that is white and sometimes is black, basically. The role of banks in France is something that is very difficult to change for the SMEs. As Arnaud mentioned, is about 92% of their financing needs. Usually, it's one bank. So there is that strong relationship with your banking partner. Even if we do see a progressive evolution of alternative lending in France, we're still talking about low numbers, as the overall market of financing, is seen. But the point is that, again, there are some, niche markets or some locations in the financing market where the banks, for the fact, related to their, their size and, their potential agility or lack of agility, can't really go. And I'm talking about my line of business. You look at factoring services in France. It's about 3% of companies using it. We're talking about only 40,000 companies, and it's something that should be seen as very shocking when you realize that every 33 minutes a company dies because clients don't pay their invoices on time. So at that time you say, okay, banks, do your job, finance at least a portion of these companies, but it's not profitable for them to go on board an SME that you're going to finance 100,000 euros a year, because that vertical approach that most French banks do still have, and I'm happy to hear that it's not the case for others, even if I knew it already, but that most French banks still have, don't make it so that these companies can get financing when they need it. In the UK, where the banks are playing a vastly different role and where factoring is unregulated, we have 11% of companies using factoring. But because in France it's subject to the banking monopoly, it's 4 times less than that. So when you look at these needs, in this space, yes, you have a vast need of cash, to answer your question, because the SMEs need a lot of financing of their working capital. That's about 75% of companies have a negative working capital, so they need to find financing for that. We can't really take that that whole approach of it's a single market that has the same characteristic, whatever the financing lines or whatever like the product we're talking about. Each vertical really has its needs, and in France I do agree that on crowdfunding, pure crowdfunding, when you're competing with the banks for like a medium to long term business, it's very difficult because the banks are lending at very cheap rates. And there is not really a credit crunch, and there has not been really a credit crunch in France. The SMEs have always found, over the past few years, when they needed lending, they found it. So yes, crowdfunding platforms really have, I would say, a more difficult position to play. It's going to be interesting to see next few years. But there are some sectors, hopefully mine, where the opportunity is much better.
Sure.
Yeah, just one small point regarding what we can do to foster the growth of good crowd lending platforms. Basically, if you look at the liabilities, you need some cash, you can find cash because there is the ECB, so there is plenty of cash everywhere. So that's not the good point for us. The good point is that if you look at the asset side, finding the right loans to make and finding the right companies to finance is much more difficult. So what we can do and what we are building now is a way to share all the, in France, if you need a loan, you go and see Bpifrance. It can be painful sometimes for us, but basically either you deserve it or not, you go and see Bpifrance. So we know the borrowers, basically. So we can share this with crowd lenders to extend their reach in terms of what are the assets which I should buy.
Mm-hmm. In the same way as in the UK, there is this referral scheme whereby banks are forced to refer SMEs that they have refused a loan to marketplace lenders. And now, if we want to talk about the advantages that fintech have or will bring to banks, I think we need to discuss a bit more about the technology, And I would like you to give your point of view about the real assets of online lenders, alternative lenders in terms of technology. Are they really faster? Are they bringing more transparency? Are they lowering the credit risk? I will first ask Markus to give his point of view on that issue, since he's serving both types of customers.
Well, we talked about a couple different things just now. We talked about customer centricity, and then we talked about owning the customer. What we were talking about earlier at the start, I would think that we're going to see a complete shift in how we think about these things going forward. I have, for example, one board member that I know would get furious at the thought of owning a customer. He would say that a customer is a person, you can't own a person. Those types of concepts, I think that they're going to disappear. Because serving the customer on the customer's terms is going to mean that you have to bring the service very similar to what Santander has done, very close to the customer, but even go beyond that. That means technology, but technology is only a hammer. I mean, it's only a tool. So at the end of the day, I think it will fundamentally change how institutions think about adoption of technology. So we're talking about, for example, the cost of acquisition of an online customer. I'm sure that, the CAC, the cost of customer acquisition, I'm not sure if banks measure that the same way as technology companies. I'm sure they will in the future. Because that line of thinking of essentially that the customer doesn't have to come to you, they will go where the service is easiest, that's going to essentially change the technology side. Sure, banks have very significant investments in technology. They have legacy systems and all of that. We worked with systems that are 40-some years old, where the only people that understand the technology block, they're retired. They'd rather spend time with their grandkids. That type of systems exist, sure. At the same time, new systems in banks, what we're talking about now, they're not being deployed on those. They're being deployed outside of the bank. That type of specialization, as it comes to customer centricity, I think that that's what we'll see. So we've been talking internally a lot about the API economy, about how specialization, modularization, and just technology development has changed in the last 5 years, 10 years. That's something that we think is radically going to change essentially the structure of how these types of thoughts are implemented. So, for example, this concept of having technology that nobody understands, black boxes that represent systematic risk. So we're hoping that's outdated in 10 years, that in 10 years, all technology that's in place is future-proof, modular, can be adapted. And then there's lots of buzzwords that I won't go into. But we hope that a data-driven approach to essentially decision-making is something that becomes prevalent in banks as well. So fundamentally, I think that the industry is moving more toward a technology-centric philosophy and ethos. And that's going to be really, really interesting to see that the customer actually gets that type of very, very focused service, whether or not that's from a financial institution that, as we know of it today, or then something else in the future. So one very specific thought that came up in one of the discussions that I've had here, that we have a lot of assumptions about service that we need and what that means today. So for example, everybody needs a place to put their money. Nobody said that that has to be a bank account, but it's almost synonymous nowadays. So these types of things, I think, will have to be re-examined, and there's going to be a lot of innovation that is put into place where it's adopted by the entire segment, maybe through competition or then consolidation.
Mm-hmm. Mariano, as an investor, you have looked into a lot of startups, I suppose. Have you seen real excellence in big data, in analytics, that you felt the banks would really need? Or do you think internally in the banks there is more and more capabilities around risk analysis, quantitative risk analysis?
Yes and no. No, I think you have to go you have to break down the credit process, and there are certain areas where fintech have a significant advantage over banks. And again, I'll use Cabbage as the best example because it's the company I chose to invest in. They are, state of the art in terms of data aggregation, in terms of facilitating a digital flow of information, of documentation, to make a risk assessment with the customer, instead of just exchanging papers via fax or having to show up with with physical copies. They just automate and digitize all of that and make it a matter of minutes instead of hours or days or weeks. And I think that is probably the biggest improvement in user experience that you can have in the credit process. So on that side, I would say, following your thoughts, fintechs win. I think on the credit underwriting itself, the risk models, there's a lot of talk about alternative data sources and new credit models using machine learning. I think the jury's out on that. It's very easy to say my models are great. No online lender, say for SOPA, has gone through a full credit cycle, so it's very hard for them to say that they have a through the cycle model that has predictive power. And in my previous life, I used to do a lot of risk management as a consultant, and plenty of banks have very, very advanced risk models using alternative data sources, and all of those models are stored in the last
drawer.
The last drawer, because through a credit crisis, their explanatory power goes to zero. Right, so I think probably some of these companies will show that their new use of machine learning techniques and more data leads to better models, but we have to go through a full crisis and then see how they react. And, it's lending money in and of itself is the same as opening that window and throwing money out of it. The hard part is getting that money back, right? And we still need to see that happening. So on that specific part, I think banks still win. The other big point I think in that perspective is, given regulation today and how capital calculations work for a bank, it takes a bank an average of 2 years to really change and adapt and evolve a risk model, because it has to go through internal validation and then it has to go through regulatory validation. Because the same models that we use to assess risk are the models we use to assess how much capital we need against those loans. Online lenders don't have that issue, and so I think there's a bit more freedom to try things, and to a certain extent a regulatory arbitrage happening that I think will again tighten up over time. So again, I think on that side I would still put my money on risk management done by banks rather than done by fintech. And then the final point where I really fall in love with the way fintechs do things is the way, talking about what you were saying about the customer relationship and owning the customer relationship and doing what the customer wants, is the way some of these lenders change the narrative, change the conversation with the customer. And again, I'm going to go to Cabbage as an example. Typically, the way it works with a bank is you show up at a branch with your stack of papers, and they say, okay, great, go home, we'll call you back in 4 weeks. And hopefully they don't call you in between to give them more information. At the end of 4 weeks, you get a yes/no answer. With someone like Cabbage, you say, I want 100,000 euros, and they will say, well, based on this little bit of information you've given me, I can offer you 50,000 at 17%. But if you give me access to a bit more data, to one of your other bank accounts or to your tax records, I might be able to give you 75 at 11%. So it doesn't become a yes/no answer anymore. Now we're talking about yes most of the time, and there's a clear incentive and an encouragement for the customer to give the bank more data and to become more transparent about their real situations, and the assessment becomes a better assessment. And the outcome for the customer is much better because, again, the answer, most of the times will be yes with these conditions. And that, I think, changes the whole way you can have a conversation. And that, again, is why we are so excited about, being able to partner with some of these players, because you can combine the best of each side to improve what the customer gets in the end.
Thank you so much. I'm afraid we are at the end of our session. I'm so sorry. I apologize to the audience because I intended to leave a time for questions to the audience. It's my fault, my bad. Thank you very much to every one of you, and have a nice lunch, everybody.